Hi, I'm Natalie from Seriously, and today we're going to have a look at cash flow. I wanted to have a quick look at cash flow with you guys, particularly because businesses are having a really hard time at the moment, and I think it's important to give you the tools necessary to try and protect yourselves. So, here we go. Cash flow. What do we mean when we talk about cash flow? So we mean making sure that a business is going to have enough cash liquid in the bank account to be able to meet all its financial requirements and pay all its bills on time. We mean monitoring how much cash goes in and out of a business to make sure that at no point will that business be in a position where it doesn't have enough cash to pay its bills and pay its staff. It is also possible to plan these transactions because there are many transactions that you know will definitely happen in your bank account. So you can plan them to see what might happen if something unexpected happens. Now, if you're using bookkeeping software, you will be able to do this in the software. There should be a report that you can run quite quickly and simply that will show you your cash flow for a given period of time. Now, whether or not that report is trustworthy all depends on the quality of the bookkeeping that is being done. So you need to make sure that when you are doing the bookkeeping that the due dates for payments of bills and the anticipated date your customers will pay you is entered. If you don't enter those dates correctly, then the bookkeeping software, it obviously won't have the correct information as to be able to pull that data out to give you the report. So if you're not entering those dates, then it's something that you should consider and perhaps start entering. Now, depending on which software you use will depend on how you run those reports. So in this video, I can't possibly show you how to run a cash flow report from your bookkeeping software for all the different softwares that are out there. I know the main ones, Xero, Sage, Free Agent, QuickBooks, they should all have those reports in there. Check on the software websites. There should be tutorials already made from your chosen software to tell you how to run that report. Of course, we are always here to give you one-to-one support. You can give us a call on the number on screen, go on our website and use our book online button if you prefer, or drop us an email if you're already one of our clients and have our details. Now, what if you're not using bookkeeping software? Can you create a cash flow report without bookkeeping software? Yes, of course you can, and it is quite simple. You're going to need a pen, paper, or you could use Microsoft Excel or Google Sheets if you're familiar with spreadsheets. The principle will be the same whether you do it in a spreadsheet or whether you do it with a pen and paper and a calculator. I just prefer a spreadsheet if I'm going to do it manually because I find it quicker to be able to do it all on screen, make changes, play with different scenarios. However, you might want to pause this video around about now and have a read of everything that's on screen. There's a lot of information. I'm not going to read from the slides for you. I'm just going to say that the way you create a cash flow report is you take your cash balance as of today's date. You decide what date you want to report your cash flow for. So that could be by the end of the day today. It could be the end of this week. It could be the end of the month. It could be 3 months or even a year. Obviously, the longer the period, the less accurate it will be because you are making more and more guesses as to what will happen in the bank account. If we're doing a short period like a week or even a month, you can be more accurate with it. So what we do is we take the starting cash balance. And when we talk about cash balance, we don't just mean cash that you have in your hand. We do mean the bank balance as well. So we start with that opening balance. You add in any monies you expect to receive that you can be sure of between now and the end of the period you're reporting on. So that could be that you are anticipating a loan coming into the bank account. So you're taking out a new loan. It could be you're expecting a big interest payment on monies that you've got sat in the savings account. It could be that you're expecting your customers to pay And it could be that those customers have already given you a check and it's not cleared the bank yet, or it could be that they have paid you on a card payment and you're waiting for that to clear the bank account. So you can be sure that those monies are going to go into your bank account. So that gives you the income that you're going to add to your statement balance. Next thing you want to do is the flip side of that. So if you know that you're going to make some payments out of the bank account in the reporting period, then you're going to want to deduct that from the balance. So that could be that you know you were going to pay a supplier because you've already sent the check perhaps. It could be that you have regular payments that go out by direct debit on the same date every month, so you can be sure that those payments will be collected by your suppliers. Anything like that. It could be a bank charge that you know will go out, perhaps if you are overdrawn and there are interest payments to be made, perhaps those are going to go out and you've already been notified by the bank of what they are. So you can deduct those from the balance. Finally, you might want to add in or take away monies because you think a customer may pay you, or because you are considering making a purchase or wondering what would happen to the cash balance if you paid some of your suppliers perhaps early. Perhaps they're offering discounts if you make your payments early, and you want to see if you can afford to do that and take advantage of those early payment discounts. Either way, you can add in and take away those balances just like we've already done to see what would happen to the cash balance. This then tells you whether or not you're going to have a problem with cash. Do you have enough cash to get you to the end of the period that you're reporting on? Or are you going to find yourself in a position where you can't make payments to suppliers, where you can't make payroll payments, those sorts of things. So moving on, there's again a lot of information on this slide, but there are things to consider. If actually you find that you have excess cash in the bank account, this is not always a good thing. You might decide that you want to make that cash work harder because it's not doing much sat in the bank account. Unfortunately, at the moment, bank accounts aren't giving very high interest rates. So you may want to decide to use that cash to generate some further income. There's many, many ways that I won't go into how you do that. Talk to your trusted advisors about how best to make your cash work harder. Obviously, we've already spoke about during times of difficulties, using this cash flow reporting to predict problems. And again, if you find that you think you're going to have a problem with cash and you haven't got enough money to make all those payments, talk to your advisors, talk to your accountant, see if there is a way to keep the business trading and bring in some extra cash, either on a short-term basis or with a more longer-term solution. So monitor your cash flow regularly. Check the cash flow before making any major purchases or changing the way you spend money. That way you can be sure that you're making the right decision. And finally, if you're not sure what these figures are telling you, talk to your trusted advisors, give your accountant or your bookkeeper a ring. They will be able to tell you what it means. And if you can't manage to put this cash flow together yourself, they will help you. That's what they're there for.